Hello, ladies and gentlemen. Good afternoon. It's Modern Investing on Pod TV. My name is Sasha Star, and today our guests are Dr. Milan Sombarak. Welcome to the show, Milan.
Thank you for inviting me. Delighted to be here.
Yeah, it's always great to have you. And Jim Ide from Ide Foundation. Welcome to the show, Jim.
Thank you for having me, Sasha.
Thank you. So the market is pretty good these days, although it's taking a breather today to find out in about an hour what's happened with interest rates and so on.
Right.
And but one stock that doesn't get rested and it punishes everybody who ignores it. It's Nvidia. Nvidia is punishing everybody who is sitting in the red and fighting to save a couple of pennies here and there. Nvidia shows the way. Go to Nvidia. Forget about all other stocks. You are losing money. You are sitting on your losses. Stop punishing yourself. Go to Nvidia. Stock is on a ramp. It will go definitely $1,000 a share in the next probably 12 months, but maybe even sooner than that because it's on a ramp. It's like every day it goes 3%, 4%, 2%, but it up and up and up. Now, if you believe that Nvidia is too late to enter, which I don't believe so, then there is alternative. It's AMD. It's in the same industry. It's not as juicy as Nvidia, but you can make a few pennies here and there on AMD. It's basically it's a poor man's Nvidia. So you can still go there and just make a little bit of money. Now, Milan, tell us what are you about and what's happening.
Well, I'd like to draw attention to our audience that we talk a lot about derivatives here. We talk a lot about puts and calls here. And actually, it can be a very dangerous area to be in. You know that Warren Buffett said that derivatives are financial weapons of mass destruction. And his partner, Charlie Munger, said that accounting for derivatives in America is a sewer, saying that accounting for derivatives in America is a sewer is an insult to sewage. And you know that about 25 years ago now, Orange County in California went bankrupt. It was the largest municipal bankruptcy in history up to that time. And it largely did so because of its involvement with puts and calls. We talk a lot about puts and calls here, so we have to warn our audiences that it can be very risky, and indeed much more money has been lost than made. But if you behave correctly, you can do quite well, and you are a good example of that. So, for instance, SPY tracks the S&P 500, which represents the American economy as a whole. And that is the strongest economy in the last 200 years. So,
small correction, if I may. It tracks 499 stocks plus Nvidia.
Okay. Is Nvidia not in the 500?
It's a separate category. 499 is the S&P. It's American economy, and Nvidia is something else.
Yeah. Okay. Thank you for that correction. So I'll tell you what I did recently. I get involved with SPY, and I'm becoming so secure with it that I'm thinking of entirely doing it in my core portfolio rather than in my fund portfolio, primarily, which I've been doing so far. So, for instance, on March the 20th, which was this last Monday, the SPY price was $394. So I sold covered calls on SPY, strike price $400, which gave it about $6 for growth, and it minimized the potential of being assigned. So that's a safe thing to do. But as it approached $400, I bought it back to get out of having a covered call on it and to own the security again outright, which allowed me, when I bought it back, it canceled the sale. I sold a covered call on it, bought it back to get out of that position, and it put me in a position to sell covered calls on it again, which I did for this coming Friday. and I got allowed $6 for growth and got $2.24 a share premium income. That's a very safe thing to do, and I could recommend that. The important thing is to do it with SPY, which tracks the American economy as a whole, which is the strongest economy in the last couple of years, a couple of 100 years. And do your covered call selling, only sell, never buy, only sell, except to cancel a position should the market price approach your selected strike price. And do it on a Monday, expiry date Friday of the same week.
No, very good question. When you sold your covered calls first time, right, and you bought it back,
Yeah.
did you end up in a plus or in a minus on just this single transaction?
So in a plus, not a very big plus, but a plus. Not a very big plus, yeah.
Yeah, that's what I figured.
Yeah, but then it put me in a position to write a cover call again with a strike price that's further out. So when you do the two together, it's a nice thing to do. But yeah, your point is well taken, Sasha, that if you buy back the cover call that you sold, then it has to be exactly the same strike price and exactly the same expiry date, because you're buying back what you sold. You have to pay for it, and then your profit is not that large. Yeah, that's true.
But essentially, were you able to do it as a single transaction, buying back your calls to close and to open another covered call position as a single transaction? Could you do that?
You know what, Sasha? I think that's possible, although I'm not sure how to do it. So I did it as two transactions, and that increases your fees, doesn't it?
Yeah, because where I'm trading at Questrade, it's I can do it as a single transaction. Now the minus though is I found out that it's not always beneficial because the market makers are trying to squeeze you on the price of when you're buying back and on the prices when you're trying to sell. So the executions sometimes are not that great. And whatever you're saving on commission, in my case, the commissions are $395 plus a dollar contract. So it's negligible. And sometimes I'm doing as a separate transactions, although I know that supposedly I should have saved some money as doing it as a single transaction, but I don't in many cases. For example, once I cashed out yesterday from the Nike position, which was a sweet deal actually. By doing really nothing, you pocket about $6,500. I'm not against that at all. And now I roll it all into next similar transaction, which is a Lululemon, which reports next Tuesday. The company is somewhat similar to Nike. It's an apparel and this business. The stock has a good run up in the last couple of days. 2-3 days or so, and I expect it to continue because I'm not sure what kind of reports they will present. But before the report, the stock will go nowhere but higher. So I sold covered calls today. Again, I could do it as a single transaction, buying stock and selling covered calls at the same time. But because I thought that the stock is moving higher, so I may do it as a two transactions. First of all, buy stock. Stock went higher somewhat. Now there is a risk because it could go lower just as well. But when you feel that money going into stock.
Well, yes, the trend is your friend. The trend is your friend until it isn't. Until it isn't. It gets to a point where it isn't a friend. Yeah.
But don't abuse your friends. If you have such a good friend and he's good to you and he's saying, Sasha, I love you, and you say, no, go to hell. No, I will not do that. So I allow stock going a little bit higher, and then I sold covered calls. So at the present time, I have shares of Lululemon, and I sold covered calls March 31st 320 calls. The stock is now trading at 308.74. So I sold far out of the money call, expecting. But you know what premium I got for them? You won't believe. $9.30. Can you imagine?
The farther out of the money you sell, the lower the premium income.
But what I'm saying, I got premium $9.30. It's 930 cents for each call. So far out of the money. It's incredible.
Oh, it is. And there has to be some risk associated with that because any spectacular return is connected to high risk. So I think I asked you the last time, what is the risk connected to what you're describing here? Because such a high return must be connected to risk.
Okay, let's answer that question precisely. So what I would like to mention is that Lululemon, first of all, it's a popular brand. It's a Canadian company which is now worldwide and selling products all over the world. And my wife is wearing quite a lot of Lululemon stuff, and my daughter and probably my granddaughter already as well. But doesn't matter that much. If you take stock is now trading at 308.81, say $309 a share. So what it did in the last year? In the last year, it was as high as $390 and as low as $279. Okay, so we are now much closer to the low entry point to the price of the stock than to the highest possible level.
Do you pay attention to the volume of trading, Sasha?
The volume of trading is pretty good, actually. The volume is approximately, average volume is 1,700,000. Today it's traded already 1,300,000. So probably it will be on average volume. And for expensive stock like this, with over $300 a share, that represents quite a bit of money going into value of the money going into stock is quite great.
We're always looking for mispricing in our favor, and you may have found an example here, Sasha, of a mispriced stock, an outlier, and you get them. And that's might explain why the returns are so good where the risk is not particularly high.
Well, we'll find out about outlier in a few days. I'm pretty sure. But what is amazing thing is that by getting $9 premium for the covered calls, now I mitigate my risk. And we were talking about risk. So if my price of the stock is say $308 minus 9, so $299. This is where I break even. I'm not even losing anything at $2.99 a share. Now, if it goes south of $2.99, that's a different story. Now I will start losing money on the shares. But right now, I'm already covered calls. And if it will go to 320, I still sitting on all the premiums. My stock went up significantly from 309 to 320. It's $11 per share. I could go higher. It could go to, say, what about 329? Then I make a very good return on stock, and I'm break even on options because I sold at 9 and I will buy back. I'm not going to buy back at any price. I'm not scared of assignments, as I said many times. So if I will be assigned, my price for assignment is $40, and we are talking about 300 shares. No, in my case, it's 600 shares at $300 per share, roughly. We are talking about a significant amount of money. What is it? 3 times 6, $180,000. So what is $40 for amount of money on the table? Is what negligence. I don't want to spend my time even to count exactly what the percentage of that is. So I don't mind assignment. Assignments are normally, most of them are happening on Friday, and most of the time you can buy the same stock, or whether it's a S&P 500, at lower price on Monday or
Oh,
Tuesday.
really? Mhm.
Absolutely, that's my rule. Never fight assignment. Let's get it be assigned. And by the way, as a result of the assignment is you're getting fat amount of
Oh,
cash.
yeah. When you get assigned, you've made money. No question. The only thing now is in order to continue the game, you have to buy it at a higher price than you sold it at. And the
Why
way,
higher? Why did you say higher price? I would like to know.
because when you're assigned, it's because the stock went up above your strike price.
It doesn't matter. What's important, most important thing is because you have to lose money buying back your options. You have to lose the commissions and all that stuff.
Right.
Why?
That's it.
Let it be assigned. You'll save yourself a lot of troubles. You'll get fat a lot of cash, and then Monday at some time, not in the morning, but sometimes after 1 o'clock, you'll buy it back at lower price, and, and you'll do all this. And say even on Monday, you still have enough time until the closing to sell your covered calls
Well,
for
yeah,
Friday.
it's certainly worth looking at. Certainly worth looking at because
Absolutely.
your expiry date is Friday of the same week, right?
Now, the problem with all that is that your accountant will charge you a little bit more money for being assigned. So you'll make probably have some profit on your stock. Then you bought it back, and then you have to start counting again. And then options you made something, and so on. So you will spend whatever money you will make. Some of it you will spend on your accountant. That's all. But it's once a year exercise. You have to go through it anyway. Other than that, this is Jim. Tell us about yourself, how you're doing these days.
Well, I'm also a big fan, as I've mentioned many times, of NVIDIA. So when you started off with that, I was happy. And I bought it in my fund portfolio when the entire sector got hammered. There was a big run on all of the semiconductor stocks and tech in general, but semiconductor stocks in particular. And that was what I considered to be, it was well under 200. And so that became attractive to me because I thought it was not only a sound company, but a promising company. It had the type of modern systems that companies need. And in order to exploit the technology that's now available, which was never available to us in the past. And now some of these companies that make silicon chips do just that, but NVIDIA does more than that. And so it was a very attractive company to me on many levels, and it was priced at an extremely attractive level. And I haven't regretted buying it. The other one that I bought at the same time was Taiwan Semiconductor. And I avoided AMD and Intel because I thought that they were more symbolic of the past. And but we
I
did
would
get
agree about Intel. AMD, I would put in different levels than Intel.
Yeah, that's worth talking about. But I also owned a lot of AMD because my wife. I wanted to talk about this. My wife worked for Xilinx, and Xilinx was acquired by AMD. So this is another way to get lucky. And when you're involved in a company that is acquired, it's generally profitable for you.
Absolutely.
Yes. So so Xilinx stock became AMD stock. So I was not interested in it because I already had it, or she had it, and we have it together.
Okay, that's good.
So that was my thinking in terms of getting into that. And so you mentioned Lululemon also, and one of the things I was very afraid of is brick and mortar stores, especially companies that expanded fairly recently, sometime in the last decade or so, that expanded their brick and mortar presence. Because what we've learned since the pandemic is that the people with brick and mortar stores have been shutting down. The malls that we see are losing stores, and but Lululemon, I think, has an online presence as well.
Oh yes, they do. Yeah.
Stores, so I think you're safe there. But I just wanted to take that as an area of risk when you're talking about these types of things. We're seeing this in restaurants in the San Francisco Bay Area, You know, they had trouble getting staff, and then people weren't going out to eat, and all of these factors came in. And you know, some lovely places have gone out of business. It's very terrible result of the pandemic, which we're putting in our rearview mirrors, but it still has present day consequences that we're all suffering. I'm going to get back to that in a second. But you also talked about the transaction fees, which are pretty much negligible. I wanted to throw another thing out there. When you're buying and selling stocks like this, there's a capital gains tax that's put onto these things. And if you buy and hold, which is what I traditionally do, then it's a capital gains tax that's much lower than if you buy and sell without holding for a period of time. It's higher. And like you say, you only have to account for that once a year. But you know, it is something that can add up, and you should pay attention to, you know, in terms of like, how much money are you making? If you're making enough money, it just doesn't matter. But if you aren't, it starts to eat into whatever profits you're making. So pay attention to that. And I think that, you know, most of the things that we're talking about here are going to take a little bit of a back seat to the general philosophy of the Fed right now. They're talking about whether or not to raise interest rates again.
Yeah.
And I'm so tired of what the Fed is looking at in terms of whether or not they make a decision to raise the price. Right now, what's happened with this Silicon Valley Bank and a couple other smaller banks, mid-range banks, has caused the Fed to pause. Maybe I won't raise the rates as much. But the point I'm trying to make here is that the Fed is looking at the wrong things in terms of what they're making the decision to raise these interest rates, which is going to cause an artificially created recession if they aren't careful. There's no need for it. The economy is not overheated. It's not supercharged. It doesn't need cooling.
Inflation is lower than expected.
Inflation was caused by the pandemic, by the breakdown of our global distribution system. And so people couldn't get the commodities that they normally would get. And so when they could get them, the prices were higher.
Right. Yeah.
This is not the traditional thing. So the Fed is still looking at the old model for how to cool off an overheated economy, which does not exist in the present day. So we're going to face perhaps an artificially, falsely created recession, which will hurt jobs. Good jobs and that pay well and that are plentiful is a good sign for the economy. It is not something to be punished by interest rate hikes. Now, I don't know how we get this message out to the Fed, but it's depressing to me that the people in charge of these types of decision making are not aware of what's really going on driving the inflation today.
You see, they started to raise interest rates too late in the cycle.
That's true. They kept it zero or at zero.
What's going on? They have to stop and start even lowering interest rates, especially with everything, all calamities, what's happened to the banks.
Yeah.
But who knows what they're going to do. But I want to tell you another interesting thing, why NVIDIA and many other tech stocks are going much higher. Because now there is everybody scrutinizing the banks for their liquidity, for their loans, and so on and on and on. And company like NVIDIA is sitting on billions of dollars cash. They can go out and buy any bank today. That's only they're not going to do it because it's not as profitable business as NVIDIA's business. So they're not going to, but they're sitting on, and nobody questions whether it's good cash or not so good cash, whether it's right deposits or not so right deposits. Just nobody questions that. And they will accumulate even more cash. So essentially, the company, if somebody would want to make a takeover bid for NVIDIA, somebody will make a takeover just for the cash that they keep in the bank. Just for that, forget about all their business.
Just drive the stock price higher. Yes.
Yeah.
But you know, Silicon Valley Bank invested in long-term treasuries, which was a tremendous mistake. I mean, once the inflation rate started, once the rates started to rise, they're what they had in terms of cash was depleted, And so then that panicked people, and they went to run on to get my money out of there, and they didn't have enough sufficient reserves, which gets me into my other hobby horse. When people talk about regulation, they want to unregulate everything. Well, regulations are part of what saves this type of problem from happening. You know, if they were,
regulation is it could be a good thing, by the way, unless there would be so many idiots and incompetent people running these banks. Unfortunately, there are
yes.
complete damn idiots who are being paid a lot of money to do what they do, and this is where regulations require 100%.
Yes.
Well, yeah, we need regulations. Yeah, you know, the Great Depression in 1929 was followed by the Glass-Steagall Act, which was enacted, I think, in 1932 or so, to separate commercial banking from investment banking. And that was a regulation that stood in place. I think Clinton did away with it because he said it no longer applies. And then we got into trouble again in 2008 because we didn't have the regulations.
And then put it in place, and they were trying to repeal it ever since. And then they repealed it, and they said, "Oops!"
But you know,
Dodd-Frank bill.
You've heard it said that a camel is a horse designed by a committee, and I wonder, and I wonder to what extent the Fed is not able to act because it's a committee to a large extent. So you know, you go back to Alan Greenspan, followed by Ben Bernanke, followed by Janet Yellen, followed by Jerome Powell. How much individual decision-making power do they have?
That's a great question, because there's people with different philosophies on those committees. And so they don't come to a consensus very easily. You know, they don't look at the same things and draw the same conclusion.
And they're not even elected officials.
Yeah, that's right.
Basically, essentially, they're political figures or political creatures, whatever you want to call them. So, but okay, I think in next half an hour, a little bit longer than that, we will find out what's happening. Jim, what is your prediction?
Well, I think that they're going to raise interest rates 1/4, which is a compromise. I think because of what the banks have gone through, what they put the public through, they were going to raise it 0.5, and now it's going to be 0.25. And I think they should be in the mindset of lowering it rather than raising it. But I don't see that happening. I think.
Milan, your prediction?
Well, bank failures, as we are facing now, you know, we've had the Silicon Valley Bank and Signature Bank, Credit Suisse. They have always in the past led to recessions. And so a recession is when the neighbor is out of work. A depression is when I am out of work. And so we can expect some serious market drops. You know, the market now today is about 10% lower than it was 1 year ago. Great buying opportunity. People who have the mindset that our members at Monday Morning Millionaire Club do see this as a buying opportunity. And it might even become a bigger buying opportunity in the future. So that's entirely possible. Bank failures have always in the past led to problems and are likely to continue that way.
Well, I think that we are relatively safe before the end of the month, March 31st. This is where the quarterly reports would have to be done by mutual funds, but also fund managers or so on. And I think we are safe until then. Now, after March 31st, going into April, it's becoming a little bit riskier environment, in my opinion. So let's enjoy last few days of March, make a little bit of money, and try to raise your cash by the end of the month, just to have even better buying opportunities, which will definitely be available very soon. Okay. Thank you so much for today's program, and have a successful week of trading, and see you next Wednesday. Bye-bye, everybody.
Delighted to participate.
Bye-bye.
Thank you and goodbye.